Hello, hello, hello. What's going on, everyone? Mic check. 1, 2, 3, 5, 4, 5, 7, 5. I'm just kidding. How's everyone doing today? All right, guys, check this out. In this video, we're going to go ahead and talk about some technical analysis, what's going on Wall Street, FOMC, and I got a nice slide deck for you guys. And by the time you walk out of this, you guys are going to be a lot more informed of what's going on, right? And this is, again, this is a real due diligence, real research, no hype, right? But just I want to do make a post about what's going on right now. Just quick side deviation. What the hell's going on in the Clover Reddit page? Oh my god, what's going on here? Anywho, yeah, I don't understand it, but hopefully once Clover becomes profitable, we'll things will get better. Okay, so overall, just quickly on the Clover here, our descending little triangle wedge here, we can start to see it starting to become respected. We do believe that this is going to be oscillating here until we get a either breakdown or break up. Because we have improving fundamental conditions and as well as what's going to be talked into this video, we do believe we're going to get a breakout. So an up. Overall, talking about IWM, we are seeing an upwards rally. It is respecting this triangle here, but we are getting to a point where we are getting an upward trajectory. So we are getting a rally, unlike what other people are saying. Okay, how are you doing, Ryan? All righty. So let's go ahead. I'm going to read off of the slides because this will end up going into a podcast. So market analysis and Federal Reserve rate cuts. So in this analysis here, we're going to talk about the market trends, the expectation for the Federal Reserve rate cuts, the implication on various economic indicators such as the 10-year risk-free rate, unemployment, and inflation. We'll explore the reasons behind the market rally and the anticipated changes in financial condition and the overall potential shift in investment strategy. So rate cut expectation at this year's start. So if you don't recall, in the beginning of the year, there was a strong market anticipation of approximately around 6 to 7 rate cuts from the Federal Reserve, right? The market was anticipating this. This expectation has been adjusted down to 3 rate cuts as confirmed by the most recent FOMC meeting we had on Wednesday. The analysis of the 10-year risk-free rate, if you go ahead and analyze this and not just look at the United States, we look at the world's risk-free rate, we find ourselves at an historic high levels. Europe's yield is near 2.5% in terms of its 10-year risk-free rate, while the United States sees fluctuations between 4.2 to 5.4%, with the 10-year treasury from the first and the 5.4 being the central bank policy rate in the latter. This doesn't obviously make sense because why is the most developed nation in the world have higher interest rates? It's very clear that we need to go ahead and dial interest rates back down, which is exactly what the Federal Reserve is doing. I'll go more specific into this. And you can basically measure other Eurozone different types of 10-year treasuries by looking at their risk-free rate, and that should be a prognostic indicator of where we're going to be, which is kind of weird because we usually set the trend. So monetary policy and market rally. So the Federal Reserve monetary policy is perceived as too tight, which is prompting the expectation of imminent rate cuts. This anticipation is a key factor in why the market is rallying. Additionally, the unemployment rate is inching towards a 2-year high, having increased by 50 basis points, which aligns with the Federal Reserve's inclination towards an interest rate cut, right? So we are starting to see softening within the labor markets. Now, inflation and interest rates. So early in the year, we discussed the seasonality effect in January characterized by an increase in CPI and a subsequent faltering in the February, despite some YouTubers creating clickbait content without market experience. We maintain that the CPI report, which includes cost for shelter, housing, and auto insurance, does not justify a hike in interest rates or a delay in rate cuts by the Federal Reserve. Thus, we consider inflation to be less imminent concern and in the review mirror. Statistical analysis and FOMC meeting. Statistical analysis used by hedge funds and quantitative trading shows a pattern leading up to the FOMC meeting. Market tends to rally when approaching these meetings, especially if it comes from a soft percentage increase. So in this rally, we were pretty much at break-even rate in terms of what the market was expecting. And then if you go ahead and analyze the percentage of the break-even rate entering all the FOMC meetings of the past, you can see that approximately greater than by chance of 50%, the market rallied. And that showed statistical power, and was actually it actually happened, which is why the S&P pretty much increased and popped the chamber here. Okay. Post FOMC meeting expectations. So, following the actual FOMC meeting, the Federal Reserve now expects higher real GDP growth of 2.1% versus 1.4%, a slightly lower unemployment rate of 4.0% versus 4.1%, with an increase in core PCE inflation. Now, if you think like, oh, wait, isn't that bad to have increased inflation? Yeah, you know what I mean? But even with all this data, despite this data, the Federal Reserve is still suggesting three rate cuts, which sparked a significant market rally. Market outlook and financial conditions. What are we looking at with this data? We anticipate financial conditions will ease. Market breadth will start expanding from a technical analysis perspective. There'll be an increase in IPOs within the equity markets. Just look at Reddit, right? The rise in investor confidence that shifts money from money market funds to stocks, which is approximately $6 trillion potential moving into equities. Impact on the housing market and liquidity. With the Federal Reserve cutting interest rates, we expect lower mortgage rates, revitalizing the housing market, and an end of quantitative tightening, which will increase market liquidity. Small caps performance and research validation. Contrary to some clickbait YouTubers that claim to understand what the market, claim to be experts, we believe small caps will perform and will let our research and our time validate this stance. I hope this video was very helpful, guys. Again, I made a kind of a jokester video yesterday, but really, guys, I take my research seriously. So I wanted to really provide you a concentrated dosage of value today within less than 8 minutes. So I hope this was helpful, and I will see you on the next one.